Hi, I'm Tim Hungerford. Welcome to the fifth part of our inventory costing series. Today we're going to have a lot of fun doing a summary of all our inventory methods. With our inventory summary, we're going to take all the different methods we've discussed and try to put them in one package so that you can understand them better. So we're going to do that by having a little bit of a party. We're going to throw a party with our bobbleheads. And the first thing they're going to do is bring some adult beverages to our party. Well, as usual, Albert Einstein was the first to the party, and being a man of genius, he thought out the best place to get his adult beverage at the best cost, and he probably used coupons too, but it only cost him $6 for his cans of adult beverage, or $1 per can. Next to the party was Mick Jagger. He stopped by at a local grocery store to pick up his six-pack of adult beverages. It wound up costing him $7.50 or $1.25 per can. As usual, Austin Powers was late to the party and didn't do any pre-planning, so he had to stop at a convenience store to pick up his six-pack of adult beverage, which now cost him $13.50 or $2.25 per can. Now let's change our thinking to assume we're running a business for a second. So the cost of our inventory would have been all three purchases added together, or $27. That means our cost of goods available will be $27 whether we use the Fifo, Lifo, or average cost method. It won't matter. Now let's return to the party. During the party, everyone started to consume the adult beverages. All right, now our party's over, so let's return back to business mode. And we've got one inventory can left. How much does this cost? Under each of the inventory methods, it would cost a different amount. So let's review those. If we had one can of inventory remaining under the Fifo method, first in, first out, that would mean that the first in stuff is gone. So the only can that would be remaining is from our Austin Powers purchase, or $2.25, which means our cost of goods sold would be $24.75 to equal our $27 total cost. Now if it was Lifo method, remember Lifo means the last stuff in is the first stuff that's gone. So that means the one remaining can must have been the ones that Albert Einstein brought in. So it would be worth $1. That means our cost of goods sold would be $26 that would flow to our income statement. Our final inventory method is average costing. We would take the total $27 that was spent on adult beverages, divide it by the 18 cans that were bought, and come up with an average cost of $1.50. So our remaining inventory can would be worth $1.50, and our cost of goods sold would be $25.50. So you can see that under all three methods, the total cost of what we purchased is the same, but each one comes up with a different value for inventory and a different value of cost of goods sold. Okay, in summary, you'll see that the different costing methods came up with different answers. So why would you do that? Well, let's explain it briefly. Lifo produced the highest cost. Higher cost means lower profit. Lower profit means lower taxes. So a lot of businesses that have been around a while like the Lifo method because it reduces the taxes that they usually have to pay. Now, most companies use the Fifo method. Fifo had the lowest cost of sales. Lower cost means higher profits, which is what investors want to see, which banks want to see when they give you a loan. So a lot of companies who use the Fifo method might see a higher profit. And finally, average costing, which gives us an average and probably the best estimate of what our inventory costs. Because as prices go up, so does the average. As prices go down, so does the average. One of the reasons why people didn't use average costing is because inventory systems weren't complicated enough to be able to do that. Now they are. So I'm seeing more and more average costing out there. The scenario that we just used is where the price of our adult beverages increased, or inflationary. If we were in a situation where our adult beverages had decreased, or a deflationary time period, then LIFO would have actually given us a higher profit and a higher tax, and FIFO would have given us a lower profit and a lower tax. So it's important to know when you're doing LIFO or FIFO whether you're in an inflationary, rising prices, or deflationary, low prices, to understand how the effects of these inventory valuation methods are on your income and your taxes. I hope that explains the three basic methods of inventory costing, and I hope you'll remember to subscribe and also comment on any other future videos you'd like to see. Have a great day.